Yo, what's going on, guys? Welcome back to my channel. Now in today's video, I'm going to be telling you guys why I do not like the wheel strategy. Now if you've been trading options or if you've been selling cash secured puts or covered calls, then you most likely have heard about the wheel strategy at least once. But for those of you that haven't heard of it, I'm just going to go ahead and give you guys a quick little explanation of it, and then I'll get into the reasons why I do not like this method and just basically why it doesn't work very well with my personal strategy. So let's go to BNGO just for an example here. So basically what you do first is you sell a put. So this is a cash secured put. So let's say I want to get in this stock at $7. It's currently trading at $7.51. Say I want to get it down at $7. So basically what I do is I sell this cash secured put, and my reward, which is the premium, I get $23 deposited into my account right away. I could use that money for whatever I want. So basically what happens is if it gets down to 7, you get assigned 100 shares because each option contract is 100 shares of a company. So in this case, you would have to pay $700 to get that 100 shares. And then what you do from there is once you have these shares, you sell a covered call on it, whichever one of these you want. You could pick it at the money, you could pick a further one out. It just really depends what your strategy is. If you're long term on this company, if you actually want to hold the stock for a while, then you're going to want to pick something higher that the stock is most likely not going to hit by expiration. But let's say you pick $10, it gets up to $10. You get your 100 shares called away at $10. What that basically means is you have to sell your shares at $10, even if it's at $12, if you've sold the $10 covered call. But you do get about $300 in upside plus the $6, so $306 plus whatever fees your brokerage charges, so roughly around $300. And then you're out of this company and you move on to the next one. Or your shares called away at $10, then you just repeat the process basically and you just sell another covered call. But that is the wheel strategy. I know there's probably a lot of other channels that do a lot better job than me at describing that. So if you're confused, you should probably just go watch another video. But those were the basics and it gives you a good idea what it is. Now I'm going to get into the points of why I do not do this and why it doesn't fit into my personal strategy for what I'm doing with covered calls. And I'm also going to give some examples of when it does work. But the point of this video is basically to give you guys my take on why I do not like it. So the first reason is the opportunity cost of doing this. So let's go into Jivo. Actually, let's use something different. Let's use something such as Palantir for a example here. So we're going to go to trade options, sell a put, and we'll just say we're going to sell one tomorrow or today, but you know it expires tomorrow. So the price of this is $23.54. I'm not going to explain how this all works again, but I'm just giving you guys my thoughts behind this and why I don't like it. But let's say I want to get into this company around $22. I only get $4 in premium. I mean, even if I do an at the money, I only get $35, which is a lot better than $4, don't get me wrong. So the biggest problem I see with this strategy, in my opinion, is that if I were to sell this one and for some reason this stock just absolutely starts taking off, then I miss all of the upside basically, and I'm just sitting here with a little, $35 in my pocket, which isn't that great. Now there are instances where I feel like cash secured puts are great tools to make some extra money in the market. Now an example of this is, say Palantir is just in a downtrend. You think it's going to keep going lower. You want to pick up some more shares. You don't really want to buy them at the current share price. But hey, if it gets down to $22, then you would get another 100 shares and you get rewarded $4 for doing that. But with my personal strategy, I'm pretty bullish on all the companies that I own. I mean, obviously, a lot of them fluctuate here and there. They're all kind of growth stocks, so it's going to be kind of crazy. It's going to be a bit of a wild ride. But in my opinion, I rather risk losing money to the downside than losing money to the upside, if you know what I mean. So we'll just go over to sell a covered call just to give you guys an idea. Now, I would never sell a covered call one day from expiration, but let's just go ahead and say April 30th just to give you guys a little bit of a better idea. So let's say I get this at $23.54 right now and I sell a $26 covered call. I get $58 Once again, not a crazy amount of money, but what you also have to see here is that if it raises from 23.54 to 26, that's $246 in my pocket plus the $58, so a little bit over $300. Where if I just sold a cash secured put and it never got hit and I never got assigned the shares, then I would just be sitting on the sidelines and I would only have about, $78. But an example we had earlier, it was April 9th and we only had $4. Now I know some people like to sell cash secured puts kind of at a further expiration date. I just don't personally like doing this because I feel like if you're doing the wheel strategy, then you're going to want to get in pretty quick, pick up your premium, and just get in and just start the wheel. I'm not saying this strategy doesn't work. I'm just pointing out the reasons why I don't like it. And one of the reasons is mainly because if it never hits your price and you actually like this stock, then you're probably better off just buying at the share price, selling a covered call, and you're able to capture a little bit of the upside if you sell a covered call a little bit out of the money. So that's the first reason. You basically miss the opportunity to capture some of the upside if you don't get assigned your shares. And basically you're only sitting there with a couple bucks in your pocket instead of a couple $100. Now the second reason I don't like this strategy is on stocks like Gevo or some of these kind of lower value stocks, or the stocks that just have monthly expiration dates. So like I said earlier, if I were to do this, I would pick a expiration date pretty close, probably 1, maybe 2 weeks at the most. But with these companies where you only have monthly expiration dates, then it's a little bit hard, because say it's April 20th right now, then you could only do the May 21st ones. Now obviously the premiums will be higher, but it just depends what the trend of the stock is, what you think it's going to do in that amount of time. If you think it's going to dip, then yeah, maybe a cash secured put is the way to go. But if you think it's going to go higher, then you're better off just buying the shares and then selling a covered call. Now there's tons of other companies out there with weekly expirations like, Neo, Apple, Tesla, Amazon, PayPal, all those. But all those require a pretty hefty chunk of change to get into. But now I just want to show you guys why I feel that this does not fit into my strategy very well, and why I haven't really implemented it in my $10,000 a month challenge. Now I'm not saying I'll never implement this into my, my strategy, but this is the reason why I don't see it working right now. So let's take Neo for example. Let's go in here, trade Neo options, sell a covered call. So just to reiterate my strategy, if you guys haven't watched my channel, I also have a video on it. You could go check out my channel. I have a video on that. So let's say I want to get into Neo. $38.84, in my opinion, right now is a great price for this company. They're obviously down right now because, the market's just kind of acting weird. And then plus there is a chip shortage, so they're getting hurt by that. And then they also took off like 5 days off of work because there was the chip shortage and they didn't feel they needed the work. So that hurt the company's price. But in my opinion, $38 is a great price. So in most instances, I would pick about a month out. So we'll just do May 7th. So I get in at 38, and sometimes I pick the at the money covered call here. But in this instance, since I love this company so much and I think that it is going to go higher over the next month here, then I would probably pick something a little bit higher. Now I still want to get a decent premium, but I also want to capture some of that upside. So let's say I picked one at $43. I get $128 in premium, and if it gets up to $43, I also get $416 on top of my $128. So that's basically my strategy. But the main reason why I don't like the cash secured put is just because I'm afraid I'm going to miss out on the upside, because a lot of the companies I buy into, I'm extremely bullish on. I mean, there's been a couple where I just kind of jump in because the premiums are high, and I kind of got burned on a couple of those, but I think they will still grow in the long term. But personally, I don't really see this $46 really stopping me from making that much more gains per year. I mean, it's not always going to be $46, but you get the point. Cash secured puts, they're going to give you a little bit of money, but they're not always going to be assigned, and you might miss out on some of the upside. So that's basically the point I'm trying to get out with this video is The opportunity cost of selling cash secured puts is that you might miss out on some of the upside. But that's my take on it, guys. I know you can make money with this strategy. I just don't like it because of those reasons that I just said. Because most of these companies I'm in, I try to be in kind of short term. They're not supposed to be long term holds, but right now there's not much I could do about some of my companies just because they got absolutely destroyed. So they're turning into long term holds, but I really don't mind it because, like I said in my strategy, I look for companies that I'm willing to hold long term if worse comes to worse. But that's my take on it, guys. Let me know what you think in the comments down below. I know I'm probably going to get a little bit of hate for this video, but I might experiment with cash secured puts a little bit more in the future, but right now I'm just focusing on covered calls. And our first month, we absolutely killed it. This month, we're kind of getting screwed just because of how down a lot of my stocks are. But, if everything continued to grow the way it was going, then yeah, we would have hit that 10K a month pretty quick, I believe. But, we just got to be patient. Everything will have its turn. Everything will eventually come back. So just keep that in mind, guys. I hope you guys enjoyed this video. If you did, make sure to leave it a thumbs up, subscribe if you're not already, and I'll see you guys in my next video. Peace out, guys.